Welcome back to Your 1230, the only podcast where our guests tell their story with the help of 12 questions in just 30 minutes. I'm your host, Mike Solitro, and today we are joined by Jim Lee. We're very excited to speak to Jim. As Jim Lee received his Bachelor of Science degree in economics from UCLA in 2010 and started his career as an inside sales representative for LoopNet Costar. Now, through real estate syndication, he's invested in over 600 units in the past 2 years. We has participated as a general partner and a limited partner. Jim, welcome. We are thrilled to be speaking with you.
Thanks for having me on the show, Mike.
Of course, of course. And I want to get to the exciting stuff, the real estate syndication and the 600 plus units that you are invested in. But before we do that, do you remember that first day at LoopNet and CoStar? And did you have a background in real estate, or what was it like walking into that office?
Great question. So to start off, yeah, I didn't have any real estate background before I started working for LoopNet and Costar. Like you said, I graduated back in UCLA back in 2010, and as you may know, that was right after the 2008 subprime mortgage crash, followed by the 2010 European debt crisis. So it was really difficult for me to find a job right off the college. Was fortunate enough to land a job as an inside sales at LoopNet, and that's kind of how propelled my real estate career. Basically, I was able to speak to real estate investors, agents, lenders, property manager on a daily basis and learn the importance of having multiple stream of income. And that's when I started to acquire real estate for additional passive income.
Very nice, very nice. I had a similar start to real estate myself, and I had no background and I had no idea what I was talking about. So in that role, we were having those conversations one after another every day. Did you have kind of a script that you went to? Did you rely on who you were talking to? How did you get through that first batch of calls?
Absolutely. So I didn't have any sales background either. I went through, I don't know, I lost count, maybe hundreds of interviews, got really good at selling myself. And eventually that's how I landed inside sales role in the interview. So like you said, I followed the script when I first started, took my job really serious because I was jobless for about a year and a half in between before finding LoopNet. And so I didn't want to go back to that stage ever again. So I worked my butt off, took the work really serious, took it home, study the materials, and eventually you kind of drift away from the script because you start to build confidence, and from there you learn more. Like as I take the materials home, I started to learn more about real estate investing on my own, pretty much all self-taught with the cap rates and things that you hear on a daily basis when you invest in real estate.
Very nice. And I think that's good advice for real estate or kind of getting started anywhere, is that learn the fundamentals, learn the basics, understand what is uniform or what can be applied to multiple situations, work hard, make it your own, and then apply it to the different situations that come up. So I think that's kind of speaks to how you're able to get to where you have in the last decade. And kind of fast forwarding, real estate syndication. How did you get started there? And just to take a step backward, for anybody listening who may not know what that means, how do you describe it to somebody who's not in that world?
Sure. So once I get started acquiring my first real estate, eventually I built a sustainable real estate portfolio that I managed to break away from my W-2 job and started a career in real estate syndication, like you talked about. A real estate syndication is basically a partnership between investors who pool their resources into one single investment. This allows you to invest in multi-million-dollar deals like multifamily properties, which is the asset class I am currently in, or any commercial buildings, industrial, office building, things like that. Syndication pretty much eliminate much of the risk while sharing in the upside. The property generates an income, then that income gets split amongst all the investors. It's a win-win scenario for everyone.
That's a good description, and it's something that I feel has become much more prevalent over the last probably 3 to 5 years for sure, and because of the reasons you describe. Is there has it become more accessible to many? Is it just becoming more regular? Why do you feel like that has become popular? You mentioned that the win-win, obviously that helps, but I do feel that in the last 5 years you see it much more frequently, and you probably stop, three people on the street and two of them are either involved or they know what it is and they're trying to get involved into a syndication.
I think A lot of people, especially the beginners, they want to get into the real estate game for the passive income, right? That's the number one goal. Everybody wants to create multiple stream of income. And once they get into it, they realize, okay, I don't want to be an active investor. I don't want to be fixing toilet. I don't want to run background check on tenants. I don't want to collect rent. I don't want to deal with all that stress. So that's where syndication investors meet, right? Because they want to be more passive. They want to focus on, doing what they do best, right? Whether it's being an engineer, being a doctor, being a lawyer, that's where they make most of their money. They don't want to manage a side business, real estate side business, and have to deal with all that. And that's where syndication comes in, because ultimately that's what when you invest in a syndication, you're investing it as a passive investor. You're not making the business decision, the day-to-day operation. It's the syndicators, the general partners that's making all the decisions.
I love that do what you do best point, that I think that either investment or whatever your day-to-day, whatever your main source of income, everyone should have multiple. Understand where your skills are, what you can do best, and what your best financial return on those skills are. So as you say, if you're a doctor, lawyer, focus there, make your money there. And if you want to have other streams, go ahead and do it. But you should not, I guess, pretend that you're a professional because you're a professional in other areas of your life. Like, they are full-time, full education, full experience roles. I do want to get into the passive income piece, because I get into different levels of conversations / arguments with people over that term passive. So we'll get into that next.
Sure.
But I want to ask first, without managing the property, being the landlord, how is that done in a syndication? Is there property management firms that are used? Are there some people in the syndication? What have you seen that's successful? So people are wondering, yeah, that sounds great. I don't want to do any of that stuff, but who does that for them?
Yeah, so great question. The reason why I got into syndication is because after, acquiring my very first deal, which is a 2-bedroom, 1-bathroom condo, I did everything from A to Z. I, run the background check, everything I mentioned earlier, collect rent, do the maintenance. And then I realized, okay, I got to automate this. I don't want to be working in the business. I want to be working on the business. And so I started to delegate tasks, right? Find vendors, find reliable contractors in case something breaks down. And I started to hire, look outside of, maybe potentially source property managers to help me look over my properties. And then I realized, if I'm doing all this, why not scale it? Why not think bigger? Why not scale it? Right. And then that's how I came across syndication and multifamily. And because ultimately syndication is, you're just doing it on a bigger scale, right? You still need all the component, all these pieces, right? Like, you still need a property management company, you still need a real estate agent, lenders, and so forth. It's a team collected effort. At the end of the day, these are all the pieces that you still need, whether you're investing in a single family resident versus 100+ unit apartment building. The only difference is the scalability, right? You can have a single family resident, one roof, right? And then you can have 100+ unit apartment building with 3 roofs. It's a lot easier to scale with 100+ units, because you just need to take care of 3 roofs, and you can hire one on-site manager to take care over 100+ units. Versus if you build like single family residence portfolio, you have up to 10 houses, you're not going to hire 10 on-site managers, right? And you have to deal with 10 roofs on top of that. So that's the scalability part. But also, you're able to attract more sophisticated people, right? When you're dealing with 100+ unit apartment building, you're dealing with, the best real estate, commercial real estate agents in the market. And you're able to establish that relationship with them, and also lenders and property managers. You're able to attract all these more, more sophisticated. So I think that's the beauty about syndication, right? It's not only does it work well on the operation side, but it also works for the investor. And that's what I mean by win-win.
And I think that you nailed it. You had me when you basically automate, delegate, scale. I think you need to go, and generally that's probably the best order to take those things. That, first of all, what can I take off of my plate without finding another person, another salary, somebody else. What can I automate without kind of thinking about putting the same effort in? Then building that team. You talk about agents, lenders, other professionals who I can bring in to delegate some of the things that either I might not be good at, I can have a better return on my time, and then start scaling. The apartment examples building is wonderful. That the effort for 100 single families is probably is exponentially greater than that 100-unit building. So when you start looking at things, being able to take a step back, and it goes back to where we started, studying what you can, knowing the fundamentals, and then extrapolating it from there. So I think that that's a wonderful example. So let's get into that passive income piece. When you are talking, and I'll take a step back, we are talking here about finance, real estate investment. We're not giving anyone specific investment advice, but we're talking about things that might be helpful in those areas. So with that in mind, passive income means different things to different folks. Do you help people understand what it looks like on a day-to-day and a long-term basis, what they can expect to see as far as returns, as far as effort, or do they have a good idea beforehand, or is it a little bit of everything when you're working with your clients?
Well, if you're talking about in terms of syndication, that's the topic, right?
Yes.
Yeah, absolutely. The way how syndication usually works is that we buy a commercial property, which is 100 plus units, and we hold it for 5 years. And what we don't promise, because that would be the wrong thing to do. But what we project on our projection is basically, at the end of 5-year hold period, we're gonna 2x your money back, 2x equity. On top of that, you're also gonna get 8% passive income, cash on cash return every year. And so that's how it looks. But what I want to set the expectation to let the investors know that when we invest in an apartment, once we took over the project, it takes time to stabilize the building, right? Once you take new management, there's going to be turnovers, and we're going to evict the tenants. We're going to renovate property, the units to add value. So you're most likely not going to see that cash flow in the first year. However, if you invest in a syndication deal with the term pref return, what that means is that even if you don't get that 8% the first year, let's just say you get paid 1% the first year, that 7% that you didn't get, it accumulates to the next year. So by next year, we'll owe you 15% and so forth. So that's the beauty of preferred return. And it's investing in a multifamily syndication. The beauty is that not only do you get the upside at the very end once we sell the property, but you also get a pretty steady stream of income, passive income over time. And how are we going to make up for the preferred return that the passive income that we didn't get paid out in the first year? Well, typically once we have a capital event, like in year 2 or 3, when we refi the property, once we add enough value, that's when you'll get a good chunk of your money. And then also when we sell the building.
Okay. Thank you for walking us through that. I think it makes it a lot more attainable and understandable when you put it in those terms and walk through the 5-year time period. How did you come up on the 5 years, or where does that come from?
That's just the standard. We're at Syndicator, we're confident that if we hold the property for 5 years and we continue to add value, whether it's build more amenities or just renovate the units in general, we're confident that we can 2x your money once we are able. Over time, not only does the appreciation and the forced appreciation, that's why we're so confident. And if we don't get 2x your money back by the end of 5 years, we'll just hold it for longer until we hit that business plan. But usually it doesn't take longer than that. I've seen deals where we are able to 2x the equity multiple in year 2, year 3. And if we're able to do that, pretty much that's our business plan, right? Where if we're able to hit that target, we'll sell the property right away.
Excellent. Okay. Thank you for that. You mentioned add value to properties by amenities, by adding things to the building that were not there before, or making it a more desirable place to live or work, as well as refinancing after a couple of years. We're in a market now where we're seeing rates higher than they were 2 or 3 years before. And, I would say it's safe to bet that we're not sure where rates are going to be in 3, 6, 12 months. How are you forecasting that? What have you been talking with your partners, people who are investing with you, when they ask, if they ask questions about, well, what's next year going to look like? What's 48 months going to look like? How are you kind of walking them through it to understand what the 5 years likely is going to be, what it could be, and how you're helping them get to the point they want to?
Yeah, so, we just keep up with the news, and as syndicator, we always have to be very, basically on top of everything, like where the market is shifting, where it's heading, and we're constantly also studying what markets to invest in. So those are great questions. I think, with the interest rates going up, what we tell our investors that, the Fed is planning on raising more interest rate, and we don't see that slowing down anytime this year. So we always put out conservative measure by raising more capital, more than we need, have additional reserves, so we can get through the downtimes like what we're going through right now, right? We don't want to overshoot ourselves. So we always have additional reserves, and that's one way of mitigating the risk, and letting the investors know that their money is going to be in good hands, because typically these multifamily apartment buildings, it's very rare to default. Back in 2008 subprime mortgage crash, we had 4% of the homes that went into foreclosure, and only 0.4% of multifamily apartments went into foreclosure. So it's a very, very stable asset.
And that makes sense. And as part of doing your best to inform and teach, educate your folks that you're investing with you, as well as to have risk mitigation factors in place. So well done there, and thank you for walking us through that. You talked about, we both have brought up, working with top professionals, building that strong team, letting everyone kind of do what they do best, because not everyone wants to be in the seat that you're in, kind of pulling all the levers, working on the business. Some people want to work in the business. So how have you been able to identify who is good at these certain things, bringing them onto your team, and then working as a unit going forward? I know that's one thing that people are always trying to get better at, trying to bring the top professionals, the top folks to their team, and sometimes doesn't always work out that way. So how have you had success, and how could you help others when they're looking to build those around them?
Yeah, absolutely. I believe big on you are who you attract. And so, um if you continue to attract the wrong people, well, you got to look deep on in yourself, and change something about yourself, right? That's something that I had to go through in my younger days. And so, for what I can tell you is that, for me, in order to syndicate my first deal, which is, I did that last year, and two deals, um I didn't have any track record or, experience indicating any deal. So it was really difficult for me to get off the ground. But I constantly put myself out there to go networking at events, and also join mastermind groups. That helps as well, because you surround yourself with people, like-minded people. And once you get involved with these groups and so forth, you'll realize that, everybody is in this game to help each other out, right? And when it comes to real estate investment, because the more you help people win, the more other people are going to help you win as well. And so, I was fortunate enough to find a business partner who's syndicated for about 10 plus years, and through his network, I was able to syndicate my first two deals last year. And I think joining mastermind group was definitely worth the investment, because I always had this mindset of, okay, I have this money, I got to go invest in real estate, but I never thought about investing in myself. And that's another thing that I would that's my answer to you, is to invest in yourself, and it'll pay dividends.
That's a great starting point to kind of build yourself up, so you can identify those folks and then put yourself in the same room, masterminds, mentoring, so you attract, as you said, those that you should be attracting, want to attract, and pull everybody forward together. I always love talking to people about their partnerships, mentors, those relationships, how they were able to build those, because those generally will also exponentially yield greater results when it's more than just 1+1, or you've got two partners that work really well together. How did you guys meet? How are you kind of playing off each other's strengths and what's next for you guys?
Yeah, so when I first started getting involved with syndication, I knew that I had one piece of the puzzle, which is being able to raise capital, because I had created this list of investors that I had been following up with ever since I became a realtor back in 2019. And so when I met him, it just clicked, because I met him at an event called Investor Summit. It's the biggest event that the Real Estate Guy radio show host. I'm not sure if you're familiar with them. It's a show run by Robert Helms and Russell Gray. And it's we met at Belize. It's a very long trip. It's like 10 days. Costs like 10 grand to be there, but you get all these heavy hitters like Robert Kiyosaki, Ken McElroy, and all these George Gammon people, at the event, just to learn from each other and so forth. And so when we met, he does everything by himself. He did everything from A to Z. Basically, he can raise capital, he sources the deal, underwrites the deal, manages the deal, and closes the deal, and so forth. And it's gotten to a point where he has 5 kids, and it's gotten to a point where he's running out of time. Yeah, so he had to delegate, but his fear was finding the wrong partner, like everybody else, right? And so I think how we clicked is because of how transparent I am, and he really liked that. Because I'm a straight shooter. I don't hide anything. If I don't have anything to show, I tell him, hey, this is what I'm at, and this is what I can offer. And he liked it, and that's how we became business partner. And and he's been in the industry for, like I said, 10 plus years. So his network is even fast, like way much greater than me, since I just started. And so I think it was through his network that we are able to syndicate a deal in Florida together.
That's a wonderful example, because you mentioned that some people, they have not had the pleasure or the luck of finding that right partner, and they are doing all of those things themselves. Some people are even good at majority of those things, or perhaps everything. But if finding the right person like yourself can take some of the tasks off of his plate and allow you to do what you're good at, now you're focusing on the things that are important. And in his case, spend more time with his family, or other areas of interest. So that's a really good example, kind of illustrating that, and how the 1+1 there is way more than two. And also, I want to highlight how much more common these events are, where you have that collaborative atmosphere. You have people who are paying a high ticket price. They are spending a lot of time away from their desk. They are all there with the mindset, the idea that we are here as a group to kind of pull everybody forward to make everyone better at the end of the 10 days than when we got here. It's not, I'm going to keep all my secrets to myself. I'm not going to share anything. I'm going to kind of hoard all the information and help anybody. Like, everyone there is kind of trying to pull everybody forward. And I think we're going to see more and more of that. And well, unfortunately, that's not everybody. That's becoming a larger number of people. And when more people win, it just becomes a better atmosphere, especially in working in vehicles like this.
Mhm.
So kind of changing gears a moment, when we first talked, one of the things that we talked about was your mentality on being a saver in general, or having that kind of looking forward and thinking about the risk mitigation piece we talked about, but having that saver's mentality. Where does that come from, and how does that creep its way into your business every day?
Yeah, great question. So I was born and raised in Taiwan with the saver's mentality. In Asian culture, we've been taught if you can't pay for something, you can't afford it. So in our mind, debt is slavery and cash is freedom, which is complete opposite of what the consumerism culture in America. So a little background on that. My first deal, it was actually a short sale. It took me a year to close that 2 bedroom, 1 bathroom condo, and it was like all cash offer. After acquiring that real estate, I realized there's so much that I don't know about real estate. So I picked up the Purple Bible, Rich Dad Poor Dad, written by Robert Kiyosaki. And I'm pretty sure you've read it. And, he talked about a lot about using debt as leverage, and why would you not use debt, and so forth. And that's when I learned the importance of having, that's when I learned that there's good debt and bad debt, right? And you want to always leverage the good debt and get rid of the bad debt, which is the credit card bills and so forth. And that always it's always at the back of my head because that's the one of the biggest lesson I learned from investing in real estate. The first lesson, and it was tough because coming from a saver's mentality, you're comfortable. You live in this little bubble, and you feel like, okay, if I can just live comfortably, debt free, why would I ever need to borrow? But the reality is, you know, as you continue to grow and expand, you're going to need to use other people's money, whether it's the bank's money or the investor's money. You know, that's the game we're playing.
Yeah, you're absolutely right that you're going to hit. It's a good mentality to have for sure. That if it's you don't have the cash, you don't have the money, you don't have the means, that stay away from it. But you're going to hit a ceiling. You're going to hit an endpoint because you're only going to be able, in most cases, to fund so many deals. You're only going to be able to have so much capital. You'll come to that natural endpoint much faster. Whereas if you identify what good debt is, you're responsible. You have the risk mitigation piece in place. You can leverage those things and likely have a better return, have a larger portfolio. And back to the what we first talked about, multiple different ways to bring income in. That's really what you want to do, especially in a real estate market where it's evolving, it's changing, it's shifting, whatever you want to call it, that there are multiple factors. So if you can be in the game multiple different ways, you've got a better likelihood of success. So I think that that story really illustrates it, that, here's where I came from. This made sense. This is how I was brought up. But then, I read the book, which I read and agree with you that, hey, there might be a little different way to do this. Here's how I can do it. And then I'm
Mhm.
surrounding myself with people who have done it that way. And together we're going further. So I love it. We are coming up on time already somehow, so I will try to end here. We've talked a lot about what your professional day to day looks like, what you've done in real estate over the last almost 15 years. What do you do to rewind, to relax? How do you kind of take time for yourself when you're not syndicating or when you're not putting real estate deals together?
Yeah, one of my hobbies is just to go out hiking, and snowboarding and so forth. Do anything that's helps keeps my mind fresh, and sometimes take a little break, take a little vacation, because we all need that at the end of the day. I think it's a good way to hit a reset button, and to give your mind freshen up so that you come back and you're able to tackle on more stuff. I feel like sometimes we work on or in the business, and we get so stressed out, and we lose track of what's important in life. And that's something that I always tell myself, hey, like, I got into this business for a reason. Not only am I going to be able to help myself create financial freedom for myself, but I'm also going to help others, like my family and friends, do it. But it's going to take time, and I just need to be patient, because that's what real estate is going to help us create wealth, but in a slow, we'll get rich, but we'll get rich slowly.
And I think the vacation part is a big thing. That if you're in a job working just to get to the vacation, you're going to burn out. It's not going to work out. But if you are in a point where you kind of are, let's say, earning those vacations, but it's something to look forward to for a time to kind of recharge and to get back at it, like that's where you want to be. That if you're living for those weekends, living for the vacations, you're probably doing the wrong thing. But as you say, if you're really working and then you're taking this time away to recharge, especially when you're taking 10 days in a beautiful locale like that to learn from others, it's kind of the best of both worlds. Do you have an upcoming trip, or where are you headed to next?
No, not at this time. I actually went to a lot of them in the past 2 years, that now I'm just building my business. But the last one I went with was Race Fest, run by Hunter Thompson. I'm not sure if you're familiar with him. And this year, I think the next event I probably will end up going is one of the syndication event run by Real Estate Guy Radio Show.
Very nice. Very nice. And Jim, where can our listeners connect with you? Where can they learn more, or if they want to kind of get involved, where can they go? What should they do?
They can check out my website, formosainvesting.com. I wrote a short 20-pager ebook of all the mistakes I learned I made as a real estate investor, so you don't have to make them. And then they can also check my social media links, LinkedIn, Facebook, Instagram at Formosa Investing.
Excellent. So we will post all that. Thank you for sharing the book. If I were to put pen to paper, my book would be longer than 20 pages. So I always appreciate when people help others say, don't make the same mistakes that I did. As you said, being transparent is really valuable, and it's not everybody. So that's great that you do that, and learn from Jim has gotten to a place in a relatively short amount of time. So read those 20 pages, take the things that he's learned and build off them. Jim, thank you so much for joining us. This has been a blast. Is there anything I didn't ask you that I probably should have tonight before I let you go?
No, everything was good. It was a great question, and it's been a pleasure to be on your show.
Likewise, this has been fun, and I look forward to doing it again down the line.
Mhm. Thank you.